welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your questions this evening are Graeme Körner from Körner Perspective and Zwelakhe Mnguni from Benguela Global Fund Managers. If you'd like to send questions, please SMS us 41392 or email stockwatch@bdtv.co.za. Graeme, Zwelakhe, good evening to you both. Nice to see you there this evening. Zwelakhe, if I may start with you, I suppose we have fewer jobs added in the United States to thank for a little bit of cheer insofar as the rand is concerned and the stock market more generally.
Yeah, indeed, Julieta. I think it does show that bit by bit the interest rate hikes are taking effect in the real economy. I think it's too early to tell that that effect would stick. But it does look like we are starting to see a slowdown in the momentum, although the US economy remains very, very resilient. So it is probably positive for people who are looking for interest rate cuts, or at least who've made bets on interest rates being cut, versus those that are expecting companies to just deliver.
Graeme, do you think, though, it is advisable to be a bit circumspect about swinging wildly either way on what the US Federal Reserve might do? Because you've seen the market expectation at the end of last year, they thought there was going to be a raft of interest rate cuts. Everyone got incredibly excited and then were bitterly disappointed, I suspect, at the start of this year. So should one just be circumspect and just dial it down, ignore the noise a little, and just look at the companies and the results that they're producing?
I think that's always the only way to approach it. But what you were just asking about the outlook for interest rates, I had the thought this afternoon, if you've ever seen like a bunch of 6 or 7-year-old kids playing netball or soccer or whatever, and they all just be like in a group chase the ball, and then the ball comes this way and they all run that way, and that's pretty much the way I feel the market is about interest rates at the moment. So it really is a case of we will just thunder after the ball. There's absolutely no logic. We all just want to swoop the ball. So I think my sense is I think the market continually sets itself up for disappointment out of the US. One less than optimistic employment number or labor number in the US, doesn't suddenly push the Fed into an aggressive cutting cycle.
Yeah.
Inflation remains stubborn. If you look at it for all practical purposes, that economy is still humming from an employment point of view. So I think the big tension at the moment is possibly the divergent path that the ECB and the Fed is going to take and the impact that may have on global markets. But, this idea that we all, in the Fed we trust, and they're going to cut rates, and that's the next adrenaline shot for markets is crazy. So I agree with you. I think we've got to be a little bit more circumspect. And if the only thing we've got to hope for is rate cuts to power the market, we're in trouble. So yeah, I would agree with you.
Okay, so let's look at the companies. There's a couple of questions actually on Richemont. And the first viewer says, what's happening with Richemont? It's no doubt a quality company with quality brands and assets, but it's come from, 3,160 Rand in mid-March to 2,650 today. It's a flop of note. I'm 20% down. Should I exit and take the tax benefits of my losses against other gains and move on, or is there any hope left? And another viewer asks, has a somewhat more optimistic view of Richemont and says, I'm up 30% in Anglo Gold. Richemont's a quality stock. Is this a wise decision to switch out of, Anglo Gold and into Richemont? So, Zwelakhe, firstly, do you think one should bail if you're 20% down on a share like Richemont?
I think then you didn't know why you're buying it if you bail. That's the first thing I'd say. I think the second thing is to highlight that in the long term, again, you have to think long term. The luxury goods businesses have done well, to varying degrees. But I do think that Richemont, while it's got very powerful brands that are well protected, and it's got good pricing power. They've protected their brands, unlike Kering with their Gucci brands that they've basically discounted to some extent. They actually, I think, at running the actual business, it's not so efficient. The productivity of the their assets, their productivity, or if you look at how swift they turn their inventories. I mean, it's a very slow process. So it does lead to them being a laggard in terms of returns when we look at it relative to other companies. In fact, we're looking at it late last week, just comparing it to other companies. I mean, Hermes has done better, Louis Vuitton has done better, Richemont on returns hasn't done so well. So I wouldn't say that the investor should bail out now, probably too late. I think I would sit through it. It's cyclical. It will probably recover at some point.
Okay, Graeme, so that would be the second part of the question. So, okay, so Zwelakhe wouldn't bail. I don't know what you would do, but would you actively look to buy it now, or would you prefer another company? I mean, as Zwelakhe says, Hermes has had a really good year so far, and LVMH also not bad.
Yeah, so I think my sense is, Richemont at 227, for example, is quite full. It's not ridiculously expensive. I have a slightly different view on their position generally in the luxury goods market, and I think the pricing of their products is quite unique. They've got quite a moat. So I think they probably, when you think about it rationally, they're probably one of the more defensive ones. The problem is that when you're paying a 20 multiple, it's not awfully defensive. So I think the positives are great brands. There's still earnings momentum. The next couple of years are not going to shoot the lights out, I don't think, because the base is going to be fairly high. But strong cash flow, they've got good cash on the balance sheet. They will return that cash. But my personal sense is one of the reasons it's probably disappointed the viewer is because the rand also has firmed up. So we've gone from 1950, for example, to the dollar to 1845, I think, as we speak.
Yeah.
So I mean, as Zwelakhe said, why did you buy it in the first place? If you're a lifetime investor and you say, whether I pay 2.6 or 2.7 or 2.2 for it, this is a business I want in my portfolio, then I would hold it. To sell it now simply to trigger the tax loss, I don't think that's awfully sensible either. So I would probably, if I had it, I would run it a little while. The viewer who's made money on Anglo Gold, I mean, if the strategy is when it's cheap, I buy it, and when I've made my money, I sell it, I would probably bank the Anglo Gold, but I don't think there's necessarily that bounce right now in Richemont. I would argue there are other stocks around the world and locally particularly that might offer you, let's say slightly more in favor asymmetric returns on the upside than the downside, whereas Richemont is kind of going into slightly uncharted territory. So I'm fairly neutral on it. I think it's a good business, but it's not as bulletproof if you look at the earnings delivery as people think. So yeah. I would urge the viewer to go and have a look at their earnings over time. And it is a little bit of a yo-yo. Obviously, it's because of all this modern accounting noise, but the reality of it is their earnings are quite volatile, and maybe we're getting towards sort of peak of cycle, and maybe luxury goods is due for a little bit of a slowdown, which I think is what a lot of people in the world are sensing. So It's a long, waffly answer to say I don't really know, but I wouldn't I wouldn't sell it just because I'm down 20%.
Okay. There's a question on letters of allocation. And the viewer says, and I don't really know what these are, so you'll be enlightening us all. Anglo American just issued letters of allocation. Can the panel please explain why these are issued, what the intended purpose is? Zwelakhe, can you clarify for us?
I'll pass that on to Graeme.
Yeah, I think it probably, if I'm not mistaken, obviously the context of the question, but I think they're talking about Anglo American, for example, has this opportunity where investors can take shares or cash, and generally if you take the drip option, you effectively, your dividend gets rolled into additional shares. So I think that's probably what they are talking about.
Okay. Then moving on to car companies, and the question is, which of BMW, Mercedes, Volkswagen and Porsche, if any, appeal as attractive buyers, given that their PEs are below 6 and their dividends are above 5%? So if you had a pick of those four, would you take, are there any obvious contenders or not?
I'd probably go with Porsche. I think the kind of customer that they appeal to is a lot more resilient than what I would say the mid-market of the car market, and I think they still provide a thrill to that customer compared to where that thrill is being taken away to some extent in the mid-market by the electric vehicles. There is some competition there, but I certainly think that if I had to choose between them, I would probably say the most resilient customer, who's the most resilient customer within that space, I'd probably go with Porsche.
Okay. Graeme, would you have a pick there?
Yeah, so yeah, in our offshore portfolios, we have a legacy holding in BMW and Volkswagen, and both of them were because of their sort of more, what we interpreted a few years ago as being a more progressive position on electric vehicles. Because if you go back maybe 4 years, BMW had actually manufactured and sold more electric cars than anybody else, including Tesla. But obviously, more recently, what you've seen is particularly, the Chinese brands are seeing a lot of traction, the likes of BYD, and both in China and elsewhere in the world, Volkswagen, I think, is battling. So historically, we've liked the company, but it feels as though all the traditional car companies that were sort of architectured on internal combustion engines and then trying to retrofit those to new powertrains, they're not getting it right, and it really is the domain of the Teslas and the BYDs of the world. So I think BMW looks to me to be relative to Volkswagen the better of the bunch. I think this whole cluster though is actually quite vulnerable right now. So I've got a bit of acid reflux courtesy of what we see in Volkswagen sales. I'm kind of hoping that they, as they have promised to do, that they attack the cost base through voluntary cuts and so forth, and that allows them the right to develop new products that are more future ready. So I think on the short term, I think Zwelakhe's probably right, Porsche, but make no mistake, I mean, the performance you're getting out of some of these not so expensive electric cars is phenomenal. So I think all of these are actually vulnerable, but yeah.
And this question now is about WeBuyCars, which will sell any car that it can get its hands on. And the question is, what's the panel's view on them? I noticed that Stockdale Street increased their holding to just over 6%. They represent the Oppenheimers, who are no fools. Is the negative sentiments going to... Okay, sorry. That's a separate question. Zwelakhe, what do you think of... If a savvy investor, a supposed savvy investor, takes a position in a company, would you consider deeply following suit?
No, I wouldn't just follow on the basis of a savvy investor. I think the question has to be, what is this business's competitive advantage? And certainly they've basically gained scale against their peers. I mean, they're nothing other than a dealership, but they've built it to a scale that they are able to churn the vehicles out quite rapidly. And that is something that has benefited them, especially with the vehicle prices going up, the new vehicle prices going up in the last few years. That has been supportive of them. So I think what we'll wait and see is to see when interest rates go down, what kind of environment would that be for them. But certainly, I think under their own brand, I think they're standing stronger than under Transaction Capital.
Okay, so just to clarify, you're not taking position in WeBuyCars anytime soon?
Not yet.
Okay. Graeme, would you dip your toe in? Or are you in already, boots and all?
No, I'm not. I think it's a good business, and I do think they've got a strong position in the market, but my anxiety, I don't know if you saw the other day in the press, there was an article that 100 billion rands worth of home loans are, at final stage before they become non-performing. So I think consumers are still battling out there. Although food inflation has moderated a little bit, and we've had a few petrol price and diesel cuts, the average consumer out there is not exactly smiling from ear to ear and looking at, their new or nearly new Fortuner or Ranger or whatever. So I think that's the environment. So I think it's a good business that is going to have a tough operating environment, at least until interest rates come off, and it may endure for a little bit longer. So I don't wish them ill.
Yeah.
I think it's a good business, but just because smart people are buying it, they may have a very different view on that than you and I do in terms of holding period and so forth. So, like Zwelakhe, I'm going to just sit it out. I've got lots of other things I can apply my mind to that I can maybe understand a little bit better.
Okay. All right. What about British American Tobacco? I think I already know your thoughts on this, Graeme, but I'm not sure if we've spoken recently, but the question is there any reason to be hopeful BTI will go up? I've held it 5 years. It's still at 500 Rand. I suppose the benefit the viewer has had is that he's got dividends, but is it enough?
Look, I think this is a typical example of where a company goes and splashes out and buys another company at a big price, and then they have to work through their debt. And I think that debt is weighing heavy on their shoulders. But I think from a operational point of view, they've been trying extremely hard to essentially exercise their pricing power, although the pirating has also come into the market quite strongly. I do think that it's probably a business that's fairly valued at the current levels. I wouldn't rush to go in. If there's a proper pullback, I'd consider it, but I think the debt and the challenging environment or the competitive environment are the two things that dissuade me from getting excited about it.
Okay, and so for the person who hasn't been excited about it for a very long time, because if the share's gone absolutely nowhere, Graeme, is this the point at which you say there are better options? And, fine, you got some nice dividends, but it's time to move on.
Yeah, I mean, that flat performance, which is not that different from a hell of a lot of companies on the JSE, has come in spite of a lot of Rand weakness. So if you were a pound or dollar denominated investor, you're really crying in your beer. So I think it's we've been saying this for a long time. It's a business that is slowly but surely dying. It is spitting cash in the meantime. They're trying to pivot into new, healthier products. But those two are going to be regulated as they rightly should be. So, it's very difficult to get optimistic about it. I'm pleased years ago that we sort of focused rather on net investments, because that has done very, very nicely as they've sort of cut their equity position in that. So that something like that you've had upside, but Pension Insurance Corporation has done very, very well. So no, I'm not excited about British American Tobacco. It's highly regulated. It's on the wrong side. They produce products that are bad for society, bad for healthcare systems, and what more can you say?
Yeah.
Gillette, I just wanted to add something to what Graeme is talking about. I think there's a lot of companies on the JSE, the so-called Rand hedges, whose poor performance sometimes is being masked by the Rand up trends towards a weaker side. And I think this Richemont situation, had we not compared it to its peers, I mean, it would look like it's a great performer, but a lot of the performance that the South African investors have realized is actually a Rand weakness rather than that it was doing exceptionally well.
Yeah, that's a very good point to make, and something that one has to consider when looking at these companies and the performance of their peers. Here's a very interesting question. Everyone is trying to figure out what's going to happen on 30th of May. Can you ask your panel what stocks, South African stocks, to buy in a positive election outcome? I suppose whatever that may be, and what will happen in a negative outcome. So if you had watched the DA's ad, a negative outcome is the conflagration of the ANC, the EFF and the MK, who will raise the country to the ground. I don't know what the positive outcome is, but Graeme, are there any obvious contenders for positive? What do you think it will be positive, and what would you shy away from if it's negative?
Well, I think, Juliette, you can just look at the shares that have underperformed for 5 years, often in spite of pretty good operational performances. So if you look at the big banks in South Africa, if you look at the market proxies, things like Coronation and 91, I would imagine they would do very, very nicely. The life offices would do well. And there are also quite a lot of investment holding companies that are trading at what I would call obscene discounts to fair value. So there are quite a few winners, but just taking the financial sector, because obviously they give you often a little bit of leverage to it. I think those would be the obvious winners. And then in a doomsday scenario, I suppose it's just anything but SA Inc.
Right. Yeah, so I mean, what for you would be a positive outcome? I guess that's, that's also the question.
Are you asking me about a positive outcome from the election or the market?
I don't know. I suppose the two are intertwined. Yeah.
Look, I'd probably say that a positive outcome would be where we get policy stability and a policy that can be implemented as well. Versus a outcome where, let's say, I mean, the ANC is still probably going to be the biggest party in the election. And if they get into a coalition with another party that is radical, and essentially we could see quite a lot of turbulence in the rand, which would feed into inflation and could create quite a unpleasant situation. So I think what would be a good outcome from our perspective is maybe the ANC gets below 51 and gets a rational partner to go into coalition with. Then your SA Inc. stocks will really run properly. I think those businesses have been under a lot of pressure, as Graeme said, and the opportunity is there for them to re-rate.
So, okay, so the obvious for the negative is just anything that's rand hedge. Notwithstanding what we've just said about their own underlying issues.
I'd say if we get a good, well-structured government, I'd probably say that the rand hedges might probably fall slightly out of favor in support of the local. So money might switch back into SA Inc. But I think if we also have to keep in mind that the global market may be under a bit of pressure as the US slows down. So it might not be a bad thing if that happens, that people could switch into SA and look for better opportunities.
Okay. All right, well then I'll get your stock picks, so there's a little bit of time to discuss them. Graeme, what are you buying at the moment?
So in spite of telling you what great value there is in South Africa, I'm actually going to but I do maintain that there's a lot of value, but we've sang their praises for a long time. So I'm going to go with something quite defensive and something quite obscure. It's called iShares is an ETF and collective investment instrument creator. There's an ETF called SPAG, SPAG, which is an agricultural producer and commodity ETF. So the rationale or the hypothesis is that agriculture is becoming more technical, more capital intensive, more complex, with let's say the power and the production moving into stronger and stronger hands, and companies that sit in this index either themselves are significant producers or they supply some of those really big producers in the US, the UK, Europe, and around the world. So I'm going to go with the SPAG index. That gives you something defensive. A couple of the companies in there are seeing negative earnings growth in this current cycle because of the bumper year, remembering what we had in terms of agri-commodities a year or two ago. But I think this one's defensive, 12 multiple, but it's not the negative view that I'm taking. It's the fact that these companies are going to be instrumental in putting food on the tables of the world and alternative protein sources, etc. So SPAG ETF.
Okay, great. Interesting one to add to the mix. Zwelakhe, how about you?
I'm going with Qualys, which is a security and compliance provider. They're a software company in the US. They run their software off the cloud and essentially help companies to comply with their regulatory requirements, but also prevent cyber attacks. The benefit is that they basically take a whole lot of a single security provider's product and integrate them into one platform where they give you one visual platform. So they have been doing very well in terms of growth and margins, and they are seeing quite a lot of support from the other companies like Accenture, Deloitte. They are their partners. So I think that in an environment where cybersecurity is a elevated issue, it could be a company that could provide some protection against that.
Okay, great. So an instrument and a company I don't think many people have heard of before, so two interesting ones to explore. Zwelakhe, Graeme, thank you very much for your time this evening, much appreciated. Graeme Körner is from Körner Perspective, Zwelakhe Mnguni is from Benguela Global Fund Managers, and up next it's The Close. Stay with us.